Trump officials reportedly blocking an agreement that would allow the UAE to buy billions of dollars worth of NVIDIA chips. A preliminary deal has been in the works since May, when President Trump visited the Middle East. But sources telling the Wall Street Journal that both countries haven't been able to work out the mechanics of the deal due to concerns that China would get its hands on NVIDIA's most advanced AI chips. They're also concerned about Huawei, which is reportedly trying to sell its chips in the Middle East as well. Officials from both the US and UAE reportedly discussed the deal in depth on the sidelines of the Tech and Energy Summit in Pittsburgh earlier this week. Let's get one take on what is unfolding here. Gil Luria is Managing Director at D.A. Davidson. He joins us live now. Gil, welcome to the program. Thanks for being here. What's your understanding of what the holdup is here, particularly after President Trump gave his approval to send these NVIDIA chips to the UAE during his visit back in May?
Yeah, the U.S. At large is trying to prevent China from having the lead in AI. Currently, most of the fastest models are coming from the U.S., but there's a lot of Chinese labs that are catching up quickly. And had they had NVIDIA's most advanced chips, they may actually be in the lead. So the U.S. is moving along multiple fronts to make sure that it sustains the lead in AI in front of China, because it sees it as a national security threat. So on one hand, it's trying to allow Chinese companies to buy degraded NVIDIA chips, but on the other hand, it's taking several measures to prevent China from having the most advanced chips, not just in terms of direct sales to China, but also sales to countries that are suspected to have forwarded or resold some of those chips to China. So that includes Singapore, Malaysia, Thailand. And from this news, it sounds like the U.S. government is concerned about shipments of the most advanced chips to the Middle East arriving in China. These are solvable problems because you could start putting trackers in some of these most advanced servers. But until they're solved, this may be a little bit of a hitch in the ability to build these data centers in countries that the U.S. is trying to restrict.
After a surprising export ban in April, NVIDIA is projected to recover billions of dollars in income if it resumes sales of its AI chips to China. According to Wall Street analysts at Stifel, Bernstein, and William Blair, NVIDIA may earn up to $15 billion in revenue from China in the second half of this year, bringing its total income from the region to about $20 billion for the fiscal year 2026, which concludes in January of next year. Compared to its approximately $17 billion in revenues from China in 2025, that would represent an increase. NVIDIA's stock shot to a new high on Tuesday after the company announced that it had secured guarantees from the Trump administration that it would be given licenses to start selling its H20 chips to Chinese consumers again. In an interview with clients on Tuesday, Stifel analyst Ruben Roy increased his price objective for NVIDIA from $180 to $202 after the news broke. Roy stated that because to pent-up demand, there will probably be a faster pace of H20 consumption from Chinese customers in the second half of the year. Roy predicts that, with its H20 sales in the first quarter, NVIDIA's revenue in China will reach $19.5 billion in 2026. However, he stated in an interview that the company's ability to meet that goal is contingent upon the tight manufacturing capacity at its contract manufacturer, TSMC. He stated that it is uncertain whether they would be able to make it all the way there. According to Bernstein analyst Stacy Rasgon, NVIDIA will make between $10 billion and $15 billion from China in the second half of the year, which means that the company will make between $15.5 billion and $20.5 billion for the entire year. However, they still need to obtain licenses, secure purchase orders, have parts manufactured, and ship them. So, what implications does this have for NVIDIA's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication. So if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on NVIDIA stock in the comments. Your support truly helps us grow. Now, let's get back to the video. In April, NVIDIA's stock plummeted after the Trump administration unexpectedly blocked the company from selling its H20 processors to China. After the US, Singapore, and Taiwan, China is one of NVIDIA's most significant markets. Chinese enterprises actually make up between 25% and 40% of NVIDIA's end customers. According to D.A. Davidson analyst Gil Luria, despite the fact that the nation only contributed 13% of the AI chipmaker's revenue in its fiscal year 2025. This is because of chip smuggling. As the U.S. government has raised national security worries over China's AI progress, NVIDIA has continually developed new, lower-power chips to sell to China in spite of increasing U.S. export limits. In 2024, the business started selling its H20 chips, which are graphics processing units built on top of its previous generation Hopper architecture. In addition to suffering a $4.5 billion inventory write-down, NVIDIA reported that it lost $2.5 billion in sales in China during the first quarter as a result of the most recent restriction imposed by Trump in April. In the second quarter, the business estimated that it would lose $8 billion in sales nationwide. According to NVIDIA CEO Jensen Huang, the Chinese AI market is valued at $50 billion. The business and analysts have maintained that China will continue to develop AI despite stricter trade regulations for AI processors. Rather, they claimed that export restrictions allow rivals to grow. The announcement from the chipmaker that it will start selling H20 chips again coincides with Huang's second trip to Beijing this year and after his meeting with Trump at the White House last week. Stacy Rasgon, an analyst at Bernstein, stated, "We are happy to see NVIDIA able to compete at least somewhat in China, as it limits potential for more structural risks, even beyond the revenue earnings recovery." Since the part's performance is already poor and far worse than that of the Chinese alternatives already on the market, we have always considered the H20 ban to be needless and, to be honest, a little absurd. A ban would merely give Huawei the Chinese AI market and promote the development of local ecosystem alternatives. The 30% decline in NVIDIA's shares between January 1st and April 5th has turned out to be a complete hoax. Shares are at all-time highs just a few months later, and many experts believe that there is much more potential to come. Now is a wonderful time to examine the stock closely because of its exceptional momentum. Is this a chance for shareholders to take some chips off the table, or will the artificial intelligence, AI, chipmaker meet the enormous expectations built into its stock? Investors anticipate continued growth from NVIDIA for years to come, in addition to more remarkable growth, given the company's current price-to-earnings ratio of over 55. Thankfully, new findings are encouraging for this kind of growth profile. The AI chipmaker announced $44.1 billion in revenue in May, a staggering 69% increase from the previous year. Quarterly revenue increased by 12% year over year. Its data center revenue was the primary driver of the quarter. The division, which supplies processors for AI models, saw a 73% increase in revenue to $39.1 billion in 2018. NVIDIA anticipates even more robust growth in Q2. The business projected $45 billion in revenue, which represents a 50% increase rate from the previous year. NVIDIA CEO Jensen Huang's confidence about the state of demand for its goods is particularly heartening. Take a look at these optimistic statements he made during the company's last results announcement. NVIDIA's AI infrastructure is in high demand worldwide. The demand for AI computation will increase as AI agents become more widely used, and the output of AI inference tokens has increased tenfold in a single year. NVIDIA is at the forefront of this significant shift as nations all over the world acknowledge AI as vital infrastructure, much like electricity and the internet. It could be easy to infer that NVIDIA is a must-buy stock given the company's remarkable economic speed and the fact that the market for AI processors seems to be in its infancy. However, there are two issues with this tech stock that are frequently disregarded. First, what will happen if the present AI chip investment cycle starts to slow down? Furthermore, what would happen if rival companies gradually developed processors that could replace NVIDIA's AI chips? NVIDIA's shares may decline if even one of these risks to the company's momentum materializes because volume and price may be under pressure at the same time. Naturally, bulls would counter that since AI is still in its infancy, there will be a far greater demand for NVIDIA's chips for a much longer period of time than some investors believe. They would also contend that NVIDIA has such a large advantage over its rivals that it is practically difficult for any of them to overtake it. These two possibilities are both possible. However, the world we live in is unclear. Intel, a chipmaker, was also formerly thought to be nearly unbeatable. However, NVIDIA and other chipmakers outperformed Intel in terms of artificial intelligence, graphics, and power efficiency, which caused Intel to drop. Even while it's difficult to see how NVIDIA might experience a similar disruption in the future, it's probably a good idea to adopt some humility when it comes to admitting risks. I think there is a fair conclusion for investors on the takeaway. Shares may be too expensive to purchase today, given NVIDIA's remarkable business momentum and the risks of a possibly slower growth rate in the future and growing competition. But if you currently possess stock, The company's outstanding performance creates a strong case for keeping it. Shareholders should be prepared for a rough ride, though, and make sure they understand the hazards involved. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
Indeed, Gil. Important to point out here that this is a Wall Street Journal report. CNBC has not been able to independently verify this reporting, but of course, we're also looking into this story. And what we do know is the fact that these national security concerns are not necessarily new. In fact, the UAE has been actively pivoting away from Chinese tech for several years now. And the development of companies like G42, for example, has really been underpinned by the growth of US interests in this region. Let's also remember that the US and the UAE have a $10 trillion investment corridor, and technology is going to play a key role in that. So what is the actual concern here? Because, as I say, this is not necessarily new.
That's right. But the changes have been rapid, and the competition between the U.S. and China is intense. Let's not forget that under the Biden administration, the restrictions around chips were very broad. They were on 180 countries, including the UAE. It's very recent that the Trump administration excluded countries like the UAE from these restrictions. And so there's also a gap or a lag between when the administrative class reacts to the changes and when the political class made the changes. The political class made the changes. We're having less restrictions on those countries. The administrative class is still catching up, and part of it is putting in place the structure, the process, and the procedures to prevent any country from forwarding and reselling the chips into China. Again, this to me is a matter of time. To your point, it's important to point out that it's important for the United States to be able to participate and be the foundation for the growth of AI in the Gulf, because if the U.S. doesn't do that, the vacuum will be filled by China. So again, it's part of that competition. It's the direction the U.S. is headed in, is working in close cooperation with the Gulf states, and especially the UAE, to develop data centers based on American technology. It just have to work out the process for doing so while reducing the risk that there'll be, again, even any amount of leakage of the top chips, the most advanced chips, from any country, including the UAE, forwarded to China.